Melbourne's property market is at a fascinating crossroads right now. After years of underperformance compared to other Australian capitals, Melbourne is showing signs of life again. Prices have been rising steadily since early 2025, buyer confidence is returning, and the market sentiment has shifted from pessimistic to cautiously optimistic. But here's the big question everyone wants answered. What will happen to Melbourne property in 2026? Will prices keep climbing? Will growth accelerate? Or will Melbourne slip back into the weakness that's plagued it for the past few years? I've analyzed data from every major bank, property research firm, and economic forecaster. I've looked at what happened in Melbourne over the past 5 years, what's happening right now, and what factors will drive the market in 2026. And I've compared Melbourne to other capitals to understand where it fits in the national picture. By the end of this video, you'll know exactly what experts are predicting for Melbourne property in 2026. You'll understand why Melbourne has been weak and why that's changing. You'll know which suburbs will perform best and which to avoid. And most importantly, you'll understand whether 2026 is the right time to buy, sell, or hold in Melbourne. Let's start by understanding where Melbourne is right now. Melbourne's current position, the numbers. Melbourne's median dwelling price currently sits at around $803,000. For houses specifically, the median is approximately $1.05 million. For units, it's about $555,000. These numbers tell an interesting story. Melbourne is now cheaper than Brisbane, which has a median of $935,000. Melbourne is cheaper than Adelaide at $843,000. Melbourne is even cheaper than Perth at $832,000. Think about that for a moment. Melbourne, Australia's second largest city with 5 million people, world-class universities, diverse economy, and global appeal, is now cheaper than much smaller capitals. This pricing makes no sense long-term, and that's exactly why 2026 looks like a pivotal year for Melbourne. Over the past 12 months, Melbourne dwelling values have risen about 0.5%. That's incredibly weak growth. Over the past 5 years, Melbourne houses have grown just 17%, while units have grown only 3%. Compare that to Brisbane houses up 68%, Adelaide up 75%, or Perth up 75%. Melbourne has been left behind. But here's what's changing. In the past few months, Melbourne's growth has accelerated. March 2025 saw Melbourne values rise 0.5%, one of the strongest monthly gains in years. This momentum has continued through to late 2025. Auction clearance rates in Melbourne have strengthened to around 70%, up from below 60% a year ago. Buyer activity is increasing, properties are selling faster, the market is turning, and 2026 is when that turn could become a real recovery. What the experts are predicting for 2026. Let's look at what the major forecasters are saying about Melbourne in 2026. Domain predicts Melbourne house prices will grow 6% in the 2025-26 financial year, taking the median to around $1.11 million. Units are forecast to grow 5%, reaching about $584,000. This would be Melbourne's strongest growth in several years. The major banks are similarly optimistic. NAB forecasts Melbourne will see 5 to 6% growth through 2026. Westpac predicts 5 to 7%. ANZ expects similar numbers around 5 to 6%. CBA is slightly more conservative at 4 to 5%. If we take an average of these forecasts, Melbourne is looking at approximately 5 to 6% price growth through 2026. That would mean house prices reaching $1.1 million to $1.12 million and units reaching $580,000 to $590,000 by the end of 2026. This doesn't sound spectacular compared to the 10 to 15% annual growth Brisbane or Perth saw in 2021-2023, but for Melbourne, it represents a significant return to form. Melbourne has been growing at 0 to 2% per year for the past few years. Jumping to 5 to 6% is a major improvement. More importantly, this growth is sustainable and based on improving fundamentals rather than speculative boom conditions. Why Melbourne has been weak. Before we talk about why Melbourne would improve, we need to understand why it's been weak. Several factors combined to hold Melbourne back. First, Melbourne had the world's longest COVID lockdowns. The city spent over 260 days in lockdown between 2020 and 2021. This damaged business confidence, drove people to leave Melbourne for regional areas or interstate, and created a negative perception of the city. Second, Victoria has the highest property taxes in Australia. Land tax in Victoria is significantly higher than other states. The state government has also introduced additional property taxes targeting investors. These taxes discourage property investment and depress demand. Third, Melbourne actually built more housing than other capitals during this period. More supply means less upward pressure on prices. While building supply is good for affordability, it's bad for price growth in the short term. Fourth, Melbourne's economy has been softer than Sydney or Brisbane. Employment growth has been slower, business confidence has been lower, economic weakness translates to property weakness. Fifth, Victoria's state finances have been under pressure with high debt levels. This has limited the state government's ability to invest in infrastructure and economic stimulus. All of these factors together created a perfect storm of weakness for Melbourne property, but most of these factors are now reversing. Why Melbourne will strengthen in 2026. The factors that held Melbourne back are changing, and new positive factors are emerging. First, interest rate cuts will benefit Melbourne more than most capitals. Melbourne has a large pool of buyers who've been sitting on the sidelines because they couldn't afford borrowing at high rates. The Reserve Bank has already cut rates 3 times in 2025, bringing the cash rate from 4.35% to 3.6%. More cuts are expected in 2026, potentially taking rates to 3.1% or lower. Each rate cut increases borrowing capacity by thousands of dollars. For Melbourne buyers who've been priced out, this brings properties back within reach as rates fall further. Second, Melbourne's relative affordability is now attracting attention. Melbourne being cheaper than Brisbane and Adelaide is attracting buyers who can't afford those markets anymore. Interstate buyers and investors are starting to look at Melbourne and realizing it offers better value. Third, Melbourne's fundamental strengths haven't disappeared. Melbourne has 5 million people, world-class universities, diverse economy, excellent healthcare, strong arts and culture, and genuine global appeal. These fundamentals mean Melbourne's weakness was always temporary rather than structural. Fourth, Melbourne's rental market is tightening. Vacancy rates are low and rents are rising. Higher rents attract investors back to the market because rental yields improve, and renters facing rising rents are motivated to buy if they possibly can. Fifth, Melbourne's building activity is moderating. While Melbourne built lots of housing in recent years, building approvals have fallen. Less new supply coming means less competition for existing properties, supporting price growth. Sixth, immigration is boosting demand. Melbourne remains a top destination for overseas migrants. The city's multiculturalism, universities, and employment opportunities attract people from around the world. These migrants need housing. Seventh, confidence is returning. The psychological shift from pessimism to optimism creates a self-reinforcing cycle. As people see prices rising and hear positive news, they become more willing to buy, which pushes prices higher, which attracts more buyers. Which Melbourne suburbs will perform best? Melbourne is a huge city with hundreds of suburbs. Not all will perform equally in 2026. Let me tell you which areas to focus on. The gentrifying middle ring suburbs in the north and west will lead growth. Areas like Reservoir, Preston, Thornbury, and Coburg have been transforming for years as young professionals and families priced out of the inner city move there. These suburbs offer proximity to the city, good transport on train lines, and improving amenities. House prices here are $800,000 to $1.2 million, which is accessible to many buyers. Expect these suburbs to grow 6 to 8% in 2026. The inner west suburbs like Footscray, Yarraville, Seddon, and Altona will continue performing strongly. These suburbs are 8 to 12 kilometers from the CBD with train stations and have been gentrifying rapidly. Young professionals love these areas. Expect 6 to 8% growth. The southeastern suburbs near Monash University and hospitals will see solid growth. Areas like Clayton, Oakley, Bentley, and Moorabbin benefit from employment at Monash University, Monash Medical Center, and other major employers. These suburbs attract both owner-occupiers and investors. Expect 5 to 7% growth. The inner city suburbs within 10 kilometers of the CBD will see steady growth, but not spectacular. Suburbs like Fitzroy, Collingwood, Richmond, South Yarra, and St. Kilda are already expensive and tightly held. They'll grow, but probably in line with the market average of 5 to 6%. The northern growth corridor suburbs with new train stations will improve performance. Areas like Mernda, South Morang, and Craigieburn have been weak, but new train infrastructure is improving their appeal. Expect 4 to 6% growth as infrastructure benefits flow through. The western suburbs like Werribee, Wyndham, and Melton will have mixed performance. These areas have huge new housing supply which limits price growth. However, suburbs with train stations will do better than car-dependent areas. Expect 3 to 5% growth. The eastern suburbs like Box Hill, Glen Waverley, and Doncaster remain strong, with good schools, shopping, and established communities. Expect solid 5 to 6% growth. The Mornington Peninsula and Bayside suburbs will see moderate growth driven by lifestyle appeal. These areas are expensive but have enduring demand. Expect 4 to 6% growth. Areas to avoid in 2026 are the outer fringe suburbs with massive new supply and no infrastructure. Places like Melton South, Truganina, and parts of Casey have thousands of new houses being built. This oversupply will keep growth weak at 2 to 4%. Also, avoid the CBD apartment market. Melbourne CBD has oversupply of apartments from all the building in recent years. Vacancy rates are high and prices are flat. CBD apartments will likely see minimal growth of 0 to 2%. Investment strategy for Melbourne in 2026. If you're considering investing in Melbourne property in 2026, here's what you need to know. Melbourne is shifting from being a market to avoid to being a market with opportunity. The weakness of the past few years has created value. Properties are relatively cheap compared to other capitals. This won't last forever. The best strategy is buying established properties in gentrifying middle-ring suburbs. These areas offer the best balance of affordability and growth potential. Look for houses or quality units near train stations within 15 kilometers of the CBD. These properties will benefit most from rate cuts, bringing buyers back. Focus on areas with infrastructure. Suburbs along existing or planned transport corridors, near universities, or near employment centers will outperform car-dependent suburbs with no infrastructure. Buy units in premium locations rather than houses in terrible locations. Melbourne's unit market has been very weak, creating significant value. A quality two-bedroom apartment in Fitzroy, Collingwood, or South Yarra for $550,000 to $650,000 could be a better investment than a house in an outer suburb with no growth prospects. Avoid the CBD apartment market and outer growth corridors. These areas have oversupply issues that will take years to resolve. For rental yield, Melbourne offers decent returns now because prices have been flat while rents increased. You can find properties yielding 4 to 5% in middle ring suburbs, which is competitive with other capitals. The timing matters. Buying in late 2025 or early 2026 positions you before the full impact of rate cuts flows through. Once rates drop to 3% or lower, demand will surge and you'll be competing with more buyers at higher prices. Getting in early captures the value before it's fully recognized by the market. First home buyers in Melbourne 2026. If you're a first home buyer looking at Melbourne in 2026, you're in a better position than buyers in Sydney or Brisbane. Melbourne's median unit price of $555,000 is significantly more affordable than Sydney's $835,000 or Brisbane's $671,000. This means your deposit requirements are lower and your mortgage will be smaller. With the first home guarantee letting you buy with 5% deposit, you need about $28,000 deposit for a $555,000 unit, plus stamp duty and costs. Total upfront cash needed is approximately $50,000 to $60,000. That's achievable for many people saving for 2 to 4 years. First home buyers should focus on units in good suburbs with train access. 2-bedroom apartments in suburbs like Box Hill, Bermwood, Footscray, Preston, or Clayton offer good value, strong rental potential if you move out later, and proximity to employment and transport. Avoid stretching to buy houses in outer suburbs just because you want a house. A unit in a strong location will serve you better long-term than a house in a weak location. The expanded first home guarantee from October 2025 with no income caps and unlimited places makes 2026 an excellent time for first home buyers to enter the market. Take advantage of these schemes before prices rise further. The risks and what could go wrong. While the outlook for Melbourne in 2026 is positive, risks exist that could derail the recovery. If interest rates don't fall as expected, or if they rise again due to inflation concerns, Melbourne's recovery could stall. Higher rates reduce borrowing capacity and buyer confidence, which would keep demand weak. If Victoria's economy weakens further with rising unemployment, property demand will suffer. Melbourne needs job growth to support population growth and housing demand. If the state government increases property taxes further, it could discourage investors and owner-occupiers. More land tax or new property taxes would be negative for the market. If building activity accelerates with lots of new supply coming to market, it could limit price growth. More supply means more competition for buyers. If interstate migration turns negative with more people leaving Melbourne than arriving, demand would weaken. Melbourne needs to attract and retain population to support property growth. If global economic conditions worsen, with a recession in the United States or China, it would impact Australia and Melbourne's economy and property market. Despite these risks, the most likely scenario is continued moderate growth through 2026 as the factors supporting recovery outweigh the risks. Final verdict. What will happen in 2026? Based on all the data and analysis, here's what I expect for Melbourne property in 2026. Melbourne house prices will likely grow 5 to 6% through 2026, reaching approximately $1.1 million to $1.12 million by the end of the year. Units will grow 4 to 5%, reaching $580,000 to $590,000. This growth will be driven by interest rate cuts improving affordability, pent-up demand from buyers who've been waiting, Melbourne's relative value compared to other capitals attracting attention, and improving confidence as the market recovers. Growth will be uneven across suburbs. Gentrifying middle-ring suburbs will lead with 6 to 8% growth. Inner-city and established areas will see solid 5 to 7% growth. Growth corridors will have moderate 4 to 5% growth, and oversupplied areas will lag with 2 to 3% growth. Melbourne won't boom like Brisbane or Perth did in 2021 to 2023, But Melbourne doesn't need to boom. Steady, sustainable growth of 5 to 6% per year is exactly what Melbourne needs and what buyers should expect. For buyers, 2026 represents opportunity. Melbourne is undervalued relative to other capitals and to its own fundamentals. Getting in before the recovery is fully priced in makes sense. For sellers, 2026 is better than 2024 or early 2025, but you're not in a super strong seller's market. Properties will sell, but you need to price realistically and present well. For investors, Melbourne offers value, decent yields, and improving growth prospects. It's no longer a market to avoid and is becoming a market to seriously consider. Melbourne's property market in 2026 will be characterized by recovery, not boom, steady growth driven by improving fundamentals, a return to form for Australia's second city, an opportunity for those who recognize the value before everyone else does. That's my prediction for Melbourne property in 2026. The city's long period of underperformance is ending, and the recovery is beginning. Understanding this shift and acting on it is how you succeed in Melbourne's property market.